All right, 30 minutes until the start of trading. Happy Halloween. I'm Matt Miller.
And I'm Danny Berger. Bloomberg Open Interest starts right now.
Coming up, the S&P is poised to extend its winning streak to a sixth month of gains as Apple and Amazon lift big tech sentiment and Nvidia scores a landmark deal.
Plus, a big oil boom. Exxon and Chevron outperform as new project and deals boost output.
And meet Dominic Ball, the only Fiserv bear in a room full of bulls, calling the stock uninvestable ahead of its crash this week.
Well, so far, everything keeping the market afloat this week, Matt, despite all the event risk, has been the big tech earnings. And it is Amazon that is surging this morning, up 13.3%. Its cloud unit saw its fastest growth since 2022 as bets on AI infrastructure begin to pay off. Apple, for their part, up 2%, predicted a jump in sales over the holiday season as its new iPhone lineup is showing strong demand. Matt, what are you looking at?
We're going to dig deep into those, but also Nvidia climbing today after CEO Jensen Huang told reporters he's hopeful its gold standard Blackwell lineup will reach Chinese customers one day. He's in Asia, where Nvidia announced a number of deals, including one of the top tech firms in South Korea. You can see Nvidia shares back up 2% in the pre-market, Danny.
Let's get more on the AI trade. Joining us now is Bloomberg Tech co-host Caroline Hyde. Caroline, it's interesting to see who has done well out of this and who has been getting raised eyebrows. Meta being a great example. For the huge amount of capital expenditures, what does the scorecard look like? Who's winning and who's falling behind?
Well, if we hold on to these pre-market gains, Amazon's going to be at a record high. So I think people would deem that they've come from behind, had a lot to prove, and they proved it. Look, I have to say, this is going to be hard to digest for many of the people who have just been told they're being laid off from the company. Some 14,000 was how we started the week, the news on that. But instead, this is Andy Jassy once again saying it's all about artificial intelligence. It is bringing us productivity across not only their e-commerce retail part of the business, that outperformed, in particular, essential items are flowing well. Revenue hit 13% growth across the entire business. But AWS bringing it back. We're up 20% year-on-year growth, much ahead of its consensus, about 2 percentage points ahead. And really, they're starting to say that even the vertical integration's working, Matt. The fact that they are bringing chips to the fore, Trainium, for example, they say is a multi-billion-dollar business now. They've won that out. They've been building juggernauts of data centers for the likes of Anthropic, and it's winning. So Amazon wins. Even Apple wins a bit today, and they're surprised in terms of growth.
Well, Apple, okay, so first of all, on Amazon, I mean, the stock has been such a dog over the past 5 years. It's really underperformed all of the other Mag 7 stocks, and 18-20% cloud growth is nothing in the face of what we saw from Microsoft or Google, right? They're looking at almost
They've got the
double.
huge market share, right?
Fair enough. Apple, the interesting thing to me is that China really disappointed by a couple of $1 billion, right? So are they really having problems in the world's biggest cell phone market?
It feels like, and your surprise is as big as many because it's down almost 4%. But the competition is so harsh there. We're seeing it with EVs, but you're seeing it with phones as well. And these other players just coming to the fore and managing to power through with artificial intelligence wrapped into the phones. Remember, that is what we're lacking from Apple iPhone 7 and 17 and 17 Pro, is the fact that Apple intelligence just isn't all that. And for many, also remember, China couldn't get their hands on the new models of phones because they aren't moving and shifting to eSIMs in quite the same way that America had. So they didn't get the uplift there from the first 2 weeks of sales. But it does seem that Tim Cook thinks next quarter is going to be different. We're seeing up to 12% growth across the board for Apple in their December quarter, and he thinks China's going to return to growth again.
But wasn't this a pretty big play for time for Apple? They didn't have the AI in there, and yet the upgrade cycle was incredibly strong, maybe not in China, but elsewhere for the new iPhone.
And the average selling price went up. Look, they're upping the iPhone 17 Pro. That's helped in terms of the price point. So too did the 17 Air, because even though maybe it didn't fly off the shelves in many ways that people anticipated, it was higher price point than what was its predecessor. But these are actually, again, companies that are being curtailed by a lack of supply. We've seen that across the board with some of these offerers of AI compute. Apple itself also had a supply chain issue and couldn't get out the new phones as quickly as many would have wanted. Maybe sales could have even been greater. So we are seeing that actually a surprising uplift. But services was where the area of growth also was. Remember, they're still able to get the money from Google, but it's notable that they are under threat with the App Store. How much longer can that services keep on winning them in terms of a uplift formula.
All right, yet another day on which Bloomberg Tech is must-watch television. Caroline Hyde and Ed Ludlow kick off that program at 11. Let's turn, though, now to big oil. Both Chevron and Exxon beating estimates before the bell, each reporting production boosts. Joining us now is Bloomberg Intelligence senior energy analyst Vincent Piazza. And Vincent, this is, I guess, all the more important given the fact that we've seen oil fall this year from $80 to $60.
Yeah, so Matt, thanks for having me on. If you think about Exxon, they're executing very well. The Permian production coming in somewhere around 1.7 million barrels a day. Overall production, 4.7 million barrels a day. If you think about the overall trend, their forward guidance from 26 to 2030, you're going to see production closer to 5.4 million. They are doing the things that they can control. Guyana, recent record of 700,000 barrels a day. Yellowtail coming online 4 months early, under budget, which is unique in the energy space. So lots of good things going in the right direction, despite the fact that we have a commodity complex that is working predominantly against them. 8 of their 10 projects coming online in 2025. 2 more right on track to come online in 2025. So all the things that they need to do, they are doing. The commodity is the headwind, but they're working fairly well within that constraint. On the Chevron side, don't expect too much on the conference call. Most of what they're going to talk about in terms of the forward outlook, spending, guidance on repurchases, longer term, that'll come next month at the November 12th Investor Day. But overall, look, they have a lot to do, right? They closed Hess in July 18th. So you saw a little bit of that in the quarter. You also saw some noise in the quarter. They outspent free cash flow with respect to dividends and also repurchases. But we're going to get a lot more clarity on the upstream side and the overall business complex on November 12th.
We'll wait for that. Vincent, thank you so much. That's Vincent Piazza of Bloomberg Intelligence. Now, elsewhere in streaming news, Netflix shares are climbing on a 10-for-1 stock split to bring the cost per share down to $100. Reuters also reporting that Netflix is actively exploring a bid for Warner Brothers Discovery studio and streaming business. Bloomberg Intelligence U.S. media analyst Geetha Raghunathan joins us now. Stock splits are my favorite, Geetha, because it proves that the efficient market hypothesis is wrong because nothing has changed in the fundamentals of Netflix, yet it is rallying. And on top of that, you have this deal news. So if Netflix is serious, how much of a contender do you think they actually are? Do you think Warner Brothers Discovery would willing just chop up their business and sell parts of it to Netflix?
I think they absolutely would, Danny. From a Warner Brothers Discovery standpoint, this is great news. The more and more parties that they have interested in their assets, that just kind of really, sets it up for a very nice bidding war. We know that Comcast is interested. We know that Paramount Skydance has already made multiple offers, which has been rejected. And now you have Netflix going after, the studio and streaming assets. This is great news for Warner Brothers. For Netflix, not so much. Yes, Warner Brothers Discovery has some great franchises. You think of DC Comics, you think of Harry Potter, Lord of the Rings. Obviously, all of that would be a great fit for Netflix, including, Warner's gaming studio. But you think of the price point, a potential price point over $60 billion. Is this really what Netflix needs? So yes, it's a defensive move, but I don't think from an economic point it really makes a lot of sense. And then, there are multiple parts of Warner's business. I don't even know what Netflix would do with them. You think about their global theatrical business or their content licensing business. I mean, Netflix would eventually have to shutter those down. So I don't know if the purchase would justify, the premium valuation that would have to be paid.
But why? I mean, isn't this where where Netflix pivots from just, producing a ton of content in high volume to actually owning distribution and IP outright and making money off of that?
This has been the constant, kind of question on investors' minds, Matt. The build versus buy strategy. So far for Netflix, Matt, the build has always worked for them. Originals now make up about 50% of their, content budget. It has performed extremely well for them. Quarter after quarter, we see them come out with some kind of a sleeper hit. It's not just established franchises like a Stranger Things or a Squid Game. I mean, you just saw K-pop Demon Hunters kind of take the world by storm. So, they've had a lot of success with originals. I'm not necessarily sure that, spending tens of billions of dollars on a studio is going to actually get them as much success as maybe investing more in originals or maybe even in sports content, which we think could be actually a game changer.
All right, Geetha, thanks very much for spending some time with us. Geetha Ranganathan of Bloomberg Intelligence going to be writing on this. You can check out her work by typing BIGO on the Bloomberg terminal. Check right now on what's going on in futures. We do see gains. S&P futures now up 2/3% after 1% drop yesterday. Concerns about, I guess, higher capex, even though that's what investors have been begging for, dropping the market.
Well, it's higher capex, but you need to have the returns, and the ratio of capex to revenue in Meta is the lowest of all the Mag 7. So maybe it's not indiscriminate selling and buying of capex that is working.
Let's also take a look at oil, because we just saw a spike on oil as the U.S., according to the Miami Herald, the U.S. has decided to attack Venezuelan military sites. And as a result, crude jumps more than 1%. So we're looking at, there's Brent up 1/3%. But the U.S. crude supplies are going to be showing a bigger spike today. And so we're seeing more than $60 a barrel on NYMEX and more than $65 on Brent.
Yeah, and Treasury futures also racing some of their declines on that move, too. How long will it last? We've seen geopolitical events have a very limited impact in terms of time on the oil prices. Some other movers on our radar this morning. There is Reddit gaining nearly 12%, a better than expected forecast for this quarter, and said daily active users grew 19% year over year.
Oh, still. Getty Images and Perplexity struck a multi-year deal to bring Getty photos to Perplexity's search engine. So some AI news driving Getty up 60% in the pre-market.
Yeah, but it's at $3.20.
It's a penny.
It's driven up by a whole dollar. Amazing. Elsewhere, Carlyle's credit arm and secondaries business helped offset disappointing earnings from its private equity unit. Shares currently unchanged in the pre-market.
I really appreciate your sarcasm on a Friday morning.
Oh, thank you.
Yeah,
it felt right.
That's excellent.
It's spooky season. Got to be a little bit, sarcastic.
Happy Halloween. Coming up, speaking of spooky season, Fiserv absolutely tanked this week, and only one analyst had a sell rating on the stock. 80% had a buy. That analyst joins us next after a customer revolt that sent those shares plunging. This is Bloomberg Open Interest. Let's get out of high interest. Look what's making headlines around the world. Payment in kind debt is surging as private credit funds use it to ease borrower strain, raising concerns it masks deteriorating loan quality. Lincoln International pegs bad pick at 6%, up from 2% in 2021, a shadow default rate. We'll get more on the private credit market next hour with Blackstone's Michael Zawadski and Blue Owl's Marc Lipschultz. So a lot to look forward to in the 10 o'clock hour. Big short investor Michael Burry sent what appears to be a cryptic warning to retail investors about market exuberance. He posted on X saying, sometimes we see bubbles, sometimes there is something to do about it, sometimes the only winning move is not to play. His post comes at a time when more and more people are questioning the financial soundness of the AI boom. Burry made his name shorting the U.S. housing market, and if you don't get the reference, he is quoting War Games, a great movie with Matthew Broderick. The lone analyst with a sell rating on Fiserv ahead of the company's crushing stock sell-off says the writing was on the wall for months. Rothschild analyst Dominic says he still has the sole sell rating on Fiserv. We can see that on the Bloomberg terminal using the ANR function. When he downgraded the stock earlier this year, he cited issues with its Clover product, a point-of-sale system, writing financial solutions is decelerating, and so the issue seems more systemic across Fiserv. And guess what? We are lucky enough to get Dominic here in the studio. He's been touring the U.S. and happens to be in New York, so perfect timing on both your call and the visit. I guess you've had this sell rating on the stock for a while, and it's actually down 70% since you put it on. Yeah. And most analysts won't say sell. In fact, only 5% of all the ratings on the Bloomberg terminal, which has, all the ratings, only 5% of analysts feel comfortable putting a sell rating on. Why do you do it?
Yeah, well, thank you for having us on to begin with. I think it's really the company I work for, Rothschild & Co Redburn. We do a lot more long-form, deep dive industrial work. When I initially did work on a peer of Clover, which is owned by Fiserv, called Toast, it was 6 months deep dive research. And that really gives us a ballast of our view and allows us to have high conviction views. Did
you have any clients push back initially when you had that buy signal? And what have they said since the big drop in prices?
Yeah, I mean, I think before Q1 for Fiserv was where there was the most contention. Fiserv was seen as the third payment company to own after the card networks. And so when you come out with quite a contrarian view, there's a lot of questions, of course. It went our way Q1 quite quickly, then it went our way in Q2, then it went our way again in Q3. And so a lot of investors just coming to us asking what is actually happening and where do we go from here.
Great story on the terminal by George McKay and Matt Turner, in which you say also that management has really focused too aggressively on Clover because there's problems there and underinvested maybe elsewhere. What's the future, you think, of the stock? What's the future of this company?
Look, it's a really tough position that they're in. Payments has a lot of technological change that's ongoing. In the last 6 months, we've seen agentic commerce and stablecoins kind of come out of nowhere. And it's tough for a company that has grown through M&A to try and consolidate and focus an R&D budget on new tech. And so peers like Toast that have a single tech stack, we really like. It allows them to have the focus in terms of serving a sole vertical, but also in that R&D budget to do well.
You also notably have a sell rating on Global Payments. You're one of only 2 analysts who have a sell rating, which is only 6% of the people who cover it. Why are you bearish on Global Payments? And by the way, I think a lot of people are going to take a second look at your sell rating now.
Yeah, again, Global Payments and Fiserv are similar when it comes to the ability in their history. They've done a lot of M&A. In payments, we've seen WorldPay, FIS, Nexi, Global Payments and First Data and Fiserv. They've all done large-scale acquisition. And again, as I mentioned, it's really difficult to innovate and change with this new tech when you've done a lot of M&A. And so we hope, and it seems like with a company like Fiserv, they're going to materially invest in the company. That was why there was such material EPS downgrades. And so that's what they can do going forward.
We're in an earnings season now where 80% of companies are beating estimates. And that sounds like a high number, but it's really not unusual. Analysts tend to do what management wants them to in order to maintain access. It's understandable. Do you find with your sell ratings that you're locked out, or is it more difficult for you to do your job?
No, again, going back to where I work, it's a very unique place, Rothschild & Co Redburn. We do deep dive industrial work. We don't typically write about the quarter, which is what every other...
Or rely on management to give you guidance.
It's what every other investment bank does. We write, as I mentioned, when we came out with Toast or Fiserv, these are 100, 200-page reports. And it allows us to look beyond the quarter, into 25, 26, 27. And then it allows us, when we do get a lot of pushback from investors, which is always natural, to give us a high conviction view, because we've done so much work on the companies.
So of all the payment companies that you cover, which is your top pick right now?
We love Toast. Toast is a fantastic company. The moat is materially underrated. People see it as similar to Clover and Fiserv. It's materially different. Their ability to win restaurants at a market share rate they're doing right now is phenomenal. Everyone keeps betting for them to slow down, and they're not doing so. It's a company that it can easily grow low 20s, easily. We have 1,000 basis points higher than that, with 35% margins, and trades at 20 times 2-year forward non-GAAP PE. If you put that in a software company, it trades at 3 times the multiple. So Toast is a materially underappreciated stock, and we really like Toast.
It's doing, over the past 5 years, and I always look at a 5-year period because it's the default for the comp function on the Bloomberg.
Yeah.
But it's down 14%. Now, it's not doing as poorly as Fiserv, obviously, which over the same period is down 40%, and Global Payments at the same period down 50%.
Yeah.
But what kind of appreciation do you expect from Toast?
Yes, we have a target price of $60. We came out being incredibly bullish when it was at 15. It's now at roughly 35. And Toast IPO'd in an environment of 0% interest rates, and we've gone to 5%. So the multiple in a lot of these companies have derated. When you look at the earnings and EBITDA, it has compounded materially. They had 0% EBITDA margin. They've scaled to 35% within 18 months, while still adding more locations for their restaurants than they've ever done before in a single year. It's a fantastic company. And our deep dive on Toast was really allowed us to then look at Clover and compare the companies. And that's really where we came up with our sell rating on Clover and Fiserv and buy on Toast.
All right, Dominic, great to get you in the studio. Thanks very much. We'll have to get you back when you put out your next report. Dominic Ball there, an analyst at Rothschild who had a sell rating on Fiserv. He has a sell rating on Global Payments. As again, only 5% of analysts in the Bloomberg universe, which is the entire universe, have sell ratings. So takes some courage and, as he points out, a lot of research. Still ahead, Sarah Hunt of Alpine Saxon Wood says, you're not spending enough on AI. That narrative has shifted to, wow, that's a lot of spending on AI. It was a short trip. She joins us at the Open to talk about where we go next. This is Bloomberg Open Interest.
A check on futures ahead of the opening bell. Thank you, Amazon, for the gains we're seeing. NASDAQ 100 futures outperformed by 1.2% with an S&P that's 0.6% higher. Russell, little changed as oil markets also hamper some of the gains in treasuries, but it's a week, Matt, where we've seen event risk after event risk. All that matters is the AI spend.
Absolutely, and 6 months in a row of gains. That's the best record that we've seen since 2020-21. We'll be back in 2 minutes' time with the opening bell. It is an exciting day for so many reasons. I mean, it's Friday, right? Kicking off the weekend. It's Halloween. It's the end of the month. It's the 6th month in a row of gains for bulls. If you're invested in the stock market, as a lot of people in America are, then you have to be a happy camper. S&P futures up another 2/3%. NASDAQ futures gaining more than 1%. There was a dip yesterday. There was a brief pause in the rally. But, you know, as Adam Johnson used to say, the pause that refreshes. You need that to keep going. Emera ringing the opening bell at the New York Stock Exchange. They have a broad portfolio of electric and natural gas energy generating assets, which obviously is in vogue right now. They're up 35% year to date. Down at the NASDAQ market site, Nomadar ringing the opening bell. Looks like maybe a soccer club, but they've got a fingerprint here. We have no idea what they do. What's the tagline?
Well, on their website, it says Nomadar makes humans whole again, and they have a really sick intro video on their landing page that shows like eyeballs and brains. I still don't know.
I see like some DNA there.
Yeah,
so
some circuits, something cool.
They're going to sell shares, so we will learn more about Nomadar in the future.
And I can't wait. In the meantime,
or not, or we'll never hear about them again.
Or we'll never know. In the meantime, all of the eyes and concentration on knowing what they do goes to Amazon. Shares here at the open up 11.5%. Their cloud unit saw the fastest growth since 2022. Those bets on AI infrastructure, they are beginning to pay off, especially considering how much Amazon has underperformed everyone by. Then there's Apple. Shares up 1.5% here at the open. They predicted a jump in sales over the holiday season with its new iPhone lineup showing strong demand. Matt, despite the fact we did not have that AI upgrade cycle that we had hoped for.
Yeah, well, you know, a positive forecast is always good from Apple. When I was a kid, they would always like sandbag a little, under promise to over deliver. So if they're doing that now, 10 to 12% is pretty hot for the fourth quarter. NVIDIA is climbing after the CEO, Jensen Huang, told reporters that he's hopeful its gold standard Blackwell lineup of chips will reach Chinese customers one day. He is in Asia, where NVIDIA announced a number of deals, including with top tech firms in South Korea. And it feels like there's not a day that goes by without NVIDIA announcing a deal. In fact, we have an amazing org chart of NVIDIA's investments in other AI companies, and then those AI companies' investments in NVIDIA, and it just goes back and forth and back and forth.
It's like the worst Venn diagram you've ever seen. It's just like this spider web of the interconnectedness.
Joe, if you pull that chart up, we can show it right now. We're talking, obviously, about AI. It's the only thing that matters. Trade deals, be damned, and the Fed. What's the Fed? Look at this. I mean, it's truly amazing.
I think someone was like, you can't show this graphic on TV because it's too confusing. That's the point. It's incredibly confusing. You can't figure out where things start and where they end.
Let's bring in Sarah Hunt right now from Alpine Saxon Wood. She's sitting here with us at the desk. And what do you make of this? Because as Marc Cudmore points out, it's the only theme that matters. But it feels pretty bubblicious thus far.
Well, I think that there was a big argument for a long time that everybody had a lot of cash and they were funding this with cash. And as that chart shows you, you're starting to get to the sort of circular arguments about, well, I'm giving money to you and you're giving money to them and they're giving money to you and it's back to you. So I think that the concern is, are we getting to the point where you're either using too much debt financing, the wrong kind of financing? Is that CapEx coming out of cash flow? And these were also companies that were asset light, right? They didn't have to, they generated a ton of cash, they had great margins, they didn't have to spend a lot of money, and now that story is changing. Right now, it's changing in a way that people don't seem to worry about. They're looking for better margins, they're looking for more productivity. We don't have to see that quite yet, but that's what the next thing is going to be, is what do you get?
By the way, yesterday, when Meta stock was off 10%, people were saying it's because they're announcing more spending on AI, but of course, they've been telling us time and time again that they're going to do that. Could it have been related to the $30 billion bond sale? I mean,
it could certainly have been related to we're raising money and margins may or may not be going up the way that we want them to. And there's a lot of different things. And also, specifically to Meta, they've had other issues where they've spent a lot of money and not seen the return on that investment. So they may be more in the penalty box on that investment than, say, a Google or an Amazon
right
now.
Meta's feels much more speculative. Microsoft was very clear in being like, we have more demand than there's capacity for. Meta was like, we just have a really good history of building stuff and having consumers want it. But to that point, Sarah, the bond auction went off without a hitch. There was a lot of oversubscription, a lot of demand.
When isn't there?
But,
when isn't there?
But
right?
on the equity side, you could usually say, when don't the stocks go up? But the stock didn't go up. So how would you want to play this? Do you want to own the equity or the debt portion of these companies and the AI build out they're doing?
Well, right now, for something like Meta, you're going to get more, if people believe the stock, you're going to get more out of the equity than you're going to get out of the bonds, just in terms of price appreciation. But remember, that stock has also been up tremendously versus some of the other ones like Apple or Amazon or even Google this year. Google had a big pop on that antitrust issue, but prior to that, they hadn't been doing as well as some of the other areas. So I don't think that the cash-rich players are places you necessarily think that you need to go into the bonds versus the equity, but it's a reasonable decision depending on what you also want to do with your own money.
By the way, I should just note that we do have Marc Lipschultz, the co-CEO of Blue Owl, on the program on his earnings at 10:30 a.m., which has been one of the entities funding this build-out of AI. A lot of it is starting to happen off of the balance sheet for these big tech players. Is that a concern at all?
I think it is ultimately going to be a concern if you don't start seeing those returns come back pretty quickly. If the returns come, it doesn't matter. If the returns don't come, then all of a sudden people are going to start looking at what that costs, what that off-balance sheet funding costs, and what they're really doing and what they're driving. And right now, since we don't yet have an answer, the optimism is there. If you start to see an issue, then it's going to be more of a problem, I think.
Speaking of credit, the Fed doesn't not matter. Right? Dallas Fed President Lori Logan said she did not support the U.S. Central Bank's decision to cut interest rates this week. And joining us with more is Bloomberg's international economics and policy correspondent, Michael McKee. Mike, what else did she say?
Well, Lori Logan joins Jeffrey Schmidt of Kansas City in statements today arguing that the Fed made a mistake on Wednesday and not supporting the idea of a December cut. Logan, in her speech text today, said, "The remaining risks to employment are ones we can monitor closely and respond to if they're becoming more likely to materialize, not ones that currently warrant further preemptive action. For these reasons, I did not see a need to cut rates this week, and I'd find it difficult to cut rates again in December unless there's clear evidence that inflation will fall faster than expected or that the labor market will cool more rapidly." As I mentioned, she followed Jeffrey Schmidt, who actually did dissent as a voter on Wednesday. He also took a swipe at the financial markets, saying financial market conditions appear to be easy across many metrics. Equity markets are near record highs, corporate bond spreads are very narrow, and high-yield bond issuance is high. None of this suggests that financial conditions are particularly tight. or that the stance of policy is restrictive. So we've been talking about a divided Fed, and now we are getting evidence of it since the blackout period has ended. Might also mention that Mickey Bowman last night said they're going to cut back the Fed's regulation and supervision staff by 30% by the end of next year, refocus on what they call material risks rather than processes. They'll do it largely through attrition and retirement incentives, but that's got to be good news for people who like financial stocks and believe that they are being held back by regulation and supervision.
All right, Michael McKee there with a couple of Fed speakers for us. Sarah Hunt from Alpine Saxon Woods still with us. She's a market strategist there. You know, this week I listened to the Fed Decides, which is, you know, Tom and John do this show, and I thought it was fantastic. Diane Swank came on and pointed out, you know, these cuts may be great for wealthy people, and if you own stocks, you know, really great. But for poor people, it's not going to help. It doesn't lower subprime rates when the Fed cuts, and the 10-year didn't go down. Right now, we're back above 4. So what can they really move by lowering rates?
I think that's one of the big conundrums right now, right? Because there's an argument that inflation may or may not be accelerating or accelerate into next year as the tariffs really come into play. There's an argument that what does cutting rates really do in an economy that's running pretty well other than that? And the tension with the labor market is not necessarily about interest rates as much as it is about the AI story that's fueling all the capex boom for everybody else. So I can be sympathetic to the argument that is rate cutting really something that needs to be done for the job market specifically. I think the other big tension back and forth is what is the neutral rate and is it still too high? And that's one of those arguments that's going to continue on and also can get quite circular. But I think that above the 350 range or above what there's some argument that another rate cut or two would be more reasonable for that. Whether or not that has the impact on either of those two issues, inflation or employment, is the real question.
Sarah, such a pleasure to have you on. And may I say, impeccably dressed this morning as well. Alpine Saxon Woods Chief Market Strategist, Sarah Hunt. Now, looking at the markets this morning, up by 0.6% as we get Amazon earnings powering everything. And this morning's rally, we are going to get more on that coming up next on the program. Again, we're going to speak to Craig Moffett of MoffettNathanson and TD Cowen's John Blackledge. That's coming up on Bloomberg Open Interest. Get you some top calls. The analyst action that we're focusing on this morning. First up, Goldman Sachs downgrading Comcast to neutral. Shares fall 1.6%. They point to the magnitude of the company's broadband pricing reset. Next up, Baird raises its target on Amazon to $285. They say 20% of AWS growth in the third quarter changes the narrative. Shares add on more than $200 billion in market cap today. And finally, Jefferies upgrading Apple to hold, seeing limited downside following strong first quarter guidance. Matt.
All right, downgrade to a hold, which is as close as a lot of analysts get to a sell. For more on Apple, we're joined by Craig Moffett, MoffettNathanson founding partner and senior research analyst. He has a neutral rating on the stock as well, with a price target of $225. Craig, what did you see in the earnings? Anything that might move you?
Well, look, the earnings were actually quite good. There weren't a lot of surprises in them, really. There was actually a positive surprise in the services revenue growth, coming in at about 13%. The market and we had been expecting 11 to 12. It may not sound like a big difference, but there were some real risks to the downside there that clearly didn't materialize. So overall, these are pretty impressive results. The reason we're stuck on the sidelines here is simply valuation. I think you're seeing that in the way the stock is trading. You're talking about a stock that came into earnings at something like 40 plus times PE multiple going into yesterday's report. Even though you're getting faster earnings growth, call it 11% now, you're still talking about a company that's trading in the mid to high 30s in PE multiple and growing much more slowly than its Mag 7 peers. And so it's just hard to see how over time it can compound as quickly as its peers. even though it's actually, again, we're quite positive about the prospects of the company. I just think you're being asked to pay a lot for a relatively modest growth rate.
Craig, I was speaking to Dan Ives of Wedbush, who is ever the Apple bull, who said that it's his expectation that Apple would partner up with Alphabet and start offering a Google Gemini service on its iPhone to supplement the lack of AI that it has. Would that be a game changer for Apple?
Well, no, it wouldn't. And to some extent, that's precisely the point, right? Let's step back a second. Remember that the reason that people got so enthusiastic about Apple coming out of last year's Worldwide Developer Conference, when the hype around AI was at its peak for Apple, it was because this was going to drive an enormous upgrade cycle. And that upgrade cycle would mean that everybody had to get a new device in order to deliver the functionality of an agentic AI that was going to be delivered by Apple on the device. That narrative has largely gone away. And while we're seeing a solid iPhone cycle this time, it's not driven by AI. It's just driven by the fact that these are good devices. If you do something with Gemini, you do something with ChatGPT, and it's in the cloud, that solves the problem to some degree, but it doesn't drive an upgrade cycle. You can do that today with any device. So what's embedded in the stock price is this much more rapid refresh rate or replacement rate of devices. It's harder to see what's going to make that happen. And again, that's not an indictment of Apple. It's simply an indictment of the enthusiasm and expectations that probably got ahead of the reality. A year or so ago, you saw Apple trade sideways. And while it's done pretty well for the last, call it a month and a half or so, it's still lagging behind both the market overall and the rest of the Mag 7, precisely because expectations had gotten so aggressive.
Craig, I'm afraid we're going to have to leave it there. Not enough time with you this morning. Craig Moffett of MoffettNathanson, thank you so much for joining. Elsewhere in the Mag 7, Amazon shares are rising, up 11.5%. It reported its fastest cloud growth since 2022. Joining us now is John Blackledge, TD Cowen Senior Equity Research Analyst. John has a buy rating with a $300 price target on Amazon. John, this is a stock that had been chronically underperforming. Before today was only up 1.5% year to date. Has Amazon showed that it deserves to play catch up with the rest of the Mag 7?
Yeah, I think so. I mean, they're at this point now they're firing on all cylinders, and the big focus was AWS, and they beat expectations. And they were bullish on forward growth. Posted 20% revenue growth, almost 3 points of acceleration. That beat investor expectations, driven by core and AI workloads. And they're really focused on accelerating AI capacity, just given the strong demand. And they told us last night, and this was kind of new metrics, that the capacity they've added over the last year is up 2x since 2022, and then they're going to double it again by 2027. So there's a lot of AI capacity coming online for AWS now and over the next couple of years. And they're filling the data centers with NVIDIA chips, AMD chips, and their own Trainium chips. And another thing about AWS, this narrative, CEO Jassy kind of dispelled this narrative around AWS and NVIDIA, saying, hey, we have a deep relationship with NVIDIA. We're not constrained from buying NVIDIA chips. We're buying them now, and we'll buy them in the future. And then they're also at the same time using their own Trainium chips, which are helping with the capacity. So net all in, with the robust growth and the capacity, we increased our AWS long-term numbers. We expect faster acceleration now, up to almost 25% growth by 2027.
So you buy that because it was beginning to look like those companies not in the Stargate, or those companies not really in the president's circle, may not be getting as many chips from Jensen as those who are. He seems to be, NVIDIA, giving a lot of chips to Oracle and Microsoft, and fewer to Amazon.
Yeah, I do buy that. I think as I said, I mean, Andy, kind of laid it out pretty clearly in his prepared remarks. And I'd also say this other thing about the AI narrative for AWS is, people calling AWS or Amazon an AI loser, they have a deep partnership with Anthropic. They're the primary cloud vendor and primary training partner. And as they announced earlier this week, they just opened up this Project Rainier, which is dedicated to training, at least the first parts of it, training the Anthropic models. Again, all of this kind of ties into us now expecting even faster acceleration at AWS.
John, Meta is also one of the companies you cover. You have a buy rating on that one as well. I'd love to get your take on yesterday. When you have Meta coming to market with a $30 billion worth of bonds, it gets 4 times oversubscribed, so the credit market likes what it sees. Yet it's an equity market that saw shares fall more than 11%, and you add weight to that today, down 1.5%. What do you make of the 2 different receptions from an equity and a bond market?
Yeah, I mean, if we look at I also obviously cover Amazon and also Alphabet. If we look at the 3 of them, Amazon and Alphabet have cloud businesses. They're all accelerating their CapEx spend to build out AI infrastructure. But we're seeing the acceleration for at AWS and Google Cloud and huge backlog growth for them. And Amazon and Alphabet are utilizing AI across their other business segments. For Meta, they are beating on revenue. And they are using AI to drive faster revenue, which is driving via higher engagement and better ad targeting. But they did lay out really aggressive OpEx and CapEx growth for next year. They'll get it. They'll give more specific guide at 4Q. But I think that kind of scared people, scared investors. But I do think CEO Zuckerberg did kind of say, listen, we're going to be aggressive with spend on AI talent and for infrastructure purposes. But listen, if superintelligence doesn't get here in the next couple of years, we'll maybe have this extra capacity that we'll sell externally. We're talking about obviously AWS earlier and their cloud growth, or we'll just pull back a little bit. So we'll have to see. It'll be pretty big at 4Q when they give that CapEx guide and initial OpEx guide for 2026.
Yeah, he did say that they continue to think they're spending aggressively enough, but then every time they look, there's more demand than they were ready for, and they have to continue to up that. So obviously people are using the capacity. John, great to get some time with you. Really appreciate you joining us. John Blackledge there of TD Cowen. Coming up at the top of the hour, we'll discuss AI portfolio allocation with Ulrike Hoffmann-Burchardi of UBS. This is Bloomberg Open Interest. This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what's going on in stocks on this October 31st. Happy Halloween. We're looking at gains here on the S&P, 68.57. The NASDAQ up 1%. Of course, there was a drop yesterday, and we have only made back about half of that, but still up for the month. And this is the 6th consecutive month of gains for U.S. stocks. Taking a look at NVIDIA, it's powering us higher today, up 1.5% after a deal with South Korea's top tech companies. Amazon absolutely crushing it with its cloud growth, now up 12%. Netflix, a lot of M&A talk around that, and Roku up 16%. NYMEX crude right now up 1% at 61.17 on the Miami Herald report that the U.S. may attack Venezuela. And then the Spider Gold Trust, GLD, actually down 0.2%. But I think it's interesting, Danny, that gold still holds at these levels as, stocks continue to power higher.
Well, Michael Hartnett over at Bank of America saying that Chinese stocks and gold are the best hedge against a boom in AI trade and that it might bring some inflation with it. More to come. You're watching Bloomberg.
"30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Danny Berger, headed for a 3rd straight week of gains in this S&P 500 fueled by the big tech earnings.
And the S&P is poised to extend its winning streak to 6 months of gains, if you're counting that way, as Apple and Amazon lift big tech sentiment and NVIDIA scores yet another deal.
Plus, a look at earnings beyond AI. Chipotle and Shake Shack warn of trouble among younger consumers.
And a check on credit. We'll hear from Wall Street Titans Michael Zawadski of Blackstone, as well as Marc Lipschultz of Blue Owl. So an hour that you don't want to miss. But we're going to kick it off with tech earnings that are fueling a rebound in stocks. Sarah Hunt of Alpine, Saxon Woods weighed in on the potential AI bubble debate.
The concern is, are we getting to the point where you're either using too much debt financing, the wrong kind of financing? Is that CapEx coming out of cash flow? And these were also companies that were asset light, right? They generated a ton of cash, they had great margins, they didn't have to spend a lot of money. And now that story is changing. Right now, it's changing in a way that people don't seem to worry about. They're looking for better margins, they're looking for more productivity. We don't have to see that quite yet, but that's what the next thing is going to be.
Joining us now is Ulrike Hoffmann-Burchardi, UBS Global Wealth America's CIO and global head of equities there. And Ulrike, it was great to get you on the show today because I saw yesterday you were quoted in our stocks wrap, which is very widely read, saying essentially that if you don't have a decent allocation to these AI stocks now or to these Mag 7 stocks, it's still not too late to get in. Is that the case?
Yeah, we believe, in fact, that AI is the most profound innovation in human history and also one of the biggest investing opportunities. But I think one thing is also clear, that AI is the new frontier, even between countries, between sectors and companies. And I think even the new divide within the Mag 7. If you look at the performance this year, we now have 3 of the Mag 7 companies underperforming the NASDAQ 100. And we believe that there is going to be a new group emerging, which may be the AI 7, that is an enabler of AI and also can profit from AI at scale. So I think that is one of the key questions in the public, but also in the private markets.
For these stocks, just discerning who is benefiting from AI and who's just, in the words of Dan Ives, putting together a good presentation that makes it sound like they're AI players. It's complicated and it's difficult. How much of a specialist do you need to be? If you are an equity investor, how deeply and intimately do you need to be able to understand what's happening in AI?
Now, if we think about AI having driven 2/3 of the returns in the S&P 500 since the launch of ChatGPT, you need to have an AI focus to understand where the equity markets are going. I think the one key question to ask is, what is OpenAI going to do? That's the big elephant in the room. It's amassed now 800 million weekly average users, 15 minutes a day, and that has captured one of the scarcest resources that we have, which is consumer attention. And I think the next big question is, how is OpenAI going to monetize that user base? And is this necessarily a zero-sum game where some of it is going to shift away from other digital consumer platforms?
Yeah, I mean, earlier this month we had Paul Tudor Jones on. Mm-hmm. You're familiar with his work. And he was saying, like, this October, to some extent, looks like October of 1999. Now, that isn't necessarily bad because we had a 92% run-up in the NASDAQ into March of 2000. But it was nearing the end of that run-up in valuations, and it took us then years to recover from that burst. Are you at all worried about a bubble burst?
We are certainly in an environment of elevated valuations, that's clear. Whether it's a bubble or a high valuation environment, for me, is largely definitional. I think one thing is clear. The investment implications have to change. Risk management has to be tighter. The higher the valuations, the more scrutiny on the fundamentals. Because markets don't correct just because of high valuations. They correct because fundamentals disappoint. And that's what we saw in 99, 2000. In the early 2000s, Lucent had a profit warning, and the dot-com companies were running out of cash. The Fed was hiking. Those were the catalyst for the implosion of the bubble in my mind, and that's for us the biggest investment takeaway.
That's huge. At a time when everybody is piling in, to say this is the time where you need to have more due diligence and extra scrutiny, does that mean that that's not happening then, Ulrike? And then there's some concerns that issues are getting papered over?
Well, I think, look, right now, we are not too concerned about the AI trade. The ROI that we have seen on enterprise use cases is huge. If you just think about the coding use case, $100 of GitHub Copilot license, you're getting 56% more productive. We're not talking about 20, 30% improvements in efficiency. That's more than 100x ROI. So we have enough data points to know that we can monetize AI. The question is one of speed, and how does it line up with the CapEx? And yeah, that is the ratio that we are continuing to monitor. But we also know this technology is very compute intense, whether it's training, whether it's inferencing, with now the reasoning models, the agentic AI framework, we estimate that we could need more than 5 times the current install base of compute by 2030. So again, monetization potential is there. It's compute intense. For us right now, we still see that ratio in line with our expectations.
So, and you've done very well with these stocks, right? If I look at the industry group breakdown of the S&P year to date, IT is up 30%, communication services, which is the hyperscalers, up 25%, utilities and industrials, that's a play on the energy they'll need, and the Caterpillar equipment to build these data centers. What else should investors be looking at outside of the AI play, or what else that we're maybe not thinking about as AI?
Yeah, one sector that we like as a diversifier to the AI trade, but yet it's also a sector that we think is long-term a huge beneficiary of AI, is the healthcare sector. Now we have some of the headwinds that we're facing that sector out of the way, with the Pfizer deal showing us the path forward on most favored nation pricing and also tariffs. And then we have upside from AI, both in the drug discovery side, but also all the way through clinical trials. We think AI could long-term reduce the cost curve of bringing a drug to market. And that now together also with the destocking finally coming to an end from COVID, with valuations relatively benign, we think that's a really attractive sector. And we have seen yesterday it's a sector that actually is up when the AI trade is down. So a very nice sector to hold as part of an AI portfolio.
We notably haven't talked about the other event risk that we got through this week, namely the Fed, and conversations between Presidents Trump and Xi. With those out of the way, Nomura's Charlie McElligott makes the argument that macro risk is on the back burner now, that now we're concerned about the right tail of AI and the melt up in equities. Is he right? Can you put aside macro as a driver of this equity market for the time being?
Yeah, we actually think that macro could be a driver for more upside. If you think about the last 12 months, we've come to all-time new highs despite a challenging macro. We think the macro, looking also into 2026, is actually improving. We have powerful fiscal and monetary tailwinds. We have, of course, defense and industrial spend on the agenda. We also have the refunds from the OBBBA bill. And then we have now the monetary stimulus through the rate cuts. And, as you said, still strong structural trends. So that's a very unique setup, very rare in the history of financial markets. So that makes us very bullish on U.S. equities in particular for this and next year.
Ulrike, thank you so much for joining us this morning. Wonderful to have you. That's Ulrike Hoffmann-Burchardi of UBS. A quick look at your equity market this morning, heading for a third week of gains, 6 months of gains, up by 0.5% for the S&P. It's an outperformance from the NASDAQ, notably not as high as the future session was, given that Apple has started to give back some of its gains. But it is a rally for the 10-year yield, despite the fact you saw some pressure on this oil market after reports of the U.S. targeting more in Venezuela. Your 10-year yield at 4.08, Matt.
All right, in terms of the single stocks moving this hour, Amazon's cloud unit saw its fastest growth since 2022 as bets on AI infrastructure begin to pay off there. And Apple predicted a jump in sales over the holiday season, but had problems in China. As a result, it is down 1/3%.
By the way, Amazon is adding almost $300 billion in market cap today with that move.
But it's only up 60% over the past 5 years, right? Look at the rest.
Yeah, it's only up, without today, it's only up 1.5% this year. So maybe it's this huge catch-up trade underway. Elsewhere, NVIDIA also climbing. CEO Jensen Huang said he's hopeful that his gold standard Blackwell lineup will reach Chinese customers one day, despite the fact Blackwell not actually being part of the talks between China and the U.S.
And we see the oil prices moving, as Danny pointed out. You've got big oil earnings as well today. Exxon and Chevron beat as new oil field projects and acquisitions boosted crude output. Hey, there's another NVIDIA headline here. You see this?
Please illuminate.
Hyundai, like Sunday, the South Korean car manufacturer, says NVIDIA's Blackwell AI factory will power its fleet, which is interesting.
It's a new day, a new deal with NVIDIA. They are popping up left and right.
Just every day there are billion-dollar deals with NVIDIA.
Well, maybe this is the thing. If you are a company that is struggling, maybe all you need is an announcement with NVIDIA to perk things up.
Joe, show the chart again. We should. I don't know if we can add Hyundai to this chart, but we have an AI chart that people absolutely love. They've been screenshotting it and sending it around about the circular economy. Well, they're the shares as well, up 1.4%. We'll bring you that. There it is. Look at that.
It's beautiful and it's
a thing of
confusing,
beauty.
and that's the point. It's a very interconnected economy. Anyway, coming up on the show, Blackstone's Michael Zawadski will be joining us as his aim and Blackstone's aim to hit $1 trillion in credit assets. They're already halfway there. That's coming up next. This is Bloomberg.
The cost of capital is coming down. The Fed's lowering rates. The long end has come down. Spreads have tightened. High yield spreads are down almost in half from their highs a couple of years ago. And we've got record highs in the stock market. That is a very good combination for more deal activity. And so if we get a little bit of calm here in the overall environment with this kind of backdrop, I would expect next year will be an even better year for M&A and IPOs.
That was Blackstone President and COO John Gray speaking with me after his company reported better than expected profit as deal-making returns. Let's get more with Michael Zawadski, Global Chief Investment Officer for Blackstone Credit and Insurance. Z, thank you so much for joining this morning.
Thanks for having me.
We should note that a lot of the growth at Blackstone has been in your business, the credit business. You are halfway to your $1 trillion goal now with the latest earnings under your belt. It seems that both the deal demand and capital is insatiable. What does it say about where we are in this credit cycle, or if we even still exist in a cycle to begin with?
Well, look, a couple of big picture things. First, I've been around the world probably twice in the last couple of months, and the demand for credit, private credit from our clients around the world has never been stronger, because I think what they see is this durable farm-to-table model that we keep talking about, the excess spread versus liquid markets that we can achieve for our clients by bringing them directly to the borrower. They also see this massive expanse of the opportunity set from what was solely a direct lending, private equity sponsor finance, to financing the real economy. That expands this market from $2 trillion in size to $30 trillion in addressable market. And there's so much untapped white space.
That's a huge jump. Say that again.
So $2 trillion is the addressable market today, mostly sponsor-backed direct lending. What we see in an addressable market is $30 trillion. So that includes financing the real economy. Think about infrastructure, real estate, energy and power. A lot of the big secular themes you see driving economic activity in the market, that's where private credit is playing a huge role.
It's this investment grade and often blue chip companies. When it's been happening, especially with a lot of these hyperscalers that are spending a lot, the question has been asked, if they're so convinced that this is the right strategy, why not go at it alone? Why involve private credit and do off-balance sheet financing? Why is there this demand from these blue chip companies, especially because they could get favorable terms in the syndicate market?
If you think about the capital need in these markets, it is massive. $2 trillion of spend in digital infra alone. Morgan Stanley expects $800 billion of that to come from private credit. And so the answer is, it's all of the above. You're going to need multiple sources of capital to finance this build out. And from our seat, if we're financing some of the best companies in the world with long-term contractual support, that's fantastic risk for our clients.
Danny is steeped in this stuff, so she knows a lot about it already. I'm sort of a novice looking at it from the outside. Does the rate environment matter to you if we go now from 4% down to 3% at the Fed? If Treasuries, the 10-year goes down to 3.5%, does that matter to you in this business, in this cycle?
Big picture, right? We've generated 10% net returns for our clients over a 20-year period. And so the absolute performance has been there. But importantly, what our clients are really focused on is that relative performance. What can private credit achieve versus what I might get in the liquid markets? And that has been consistently 200 basis points or greater, whether you're talking about investment grade risk or sub-investment grade risk. And interestingly, when cost of capital is coming down, when rates are coming down, when spreads are coming down, that is when the excess spread that private credit can deliver is even more impactful to our client portfolios. It's not a coincidence that a huge inflection point for private credit came in 2021 when rates were zero.
So you've been around the world twice in recent weeks. So two questions. One, do you sleep? I'm guessing the answer to that is probably no. Two, Is the cockroach of it all still being brought up? Is that still a top question among clients if there are hidden risks in the private credit market that aren't appreciated?
Look, it's on the sleeve question, not as much as I would like, certainly. On the risk, of course it's being asked. And the clients are right to be asking because they're reading about it and they want to know what's going on. And that's where facts really matter. And what we see, actually something that I think is really underreported, is that defaults are actually down in the leveraged loan and high yield market 37% on a year-to-date basis versus where they were 2 years ago. The economy is performing quite strongly. I know you spent a lot of time talking about Q3 earnings, which continue to be robust. So you have a very nice backdrop in credit. And what we're doing is mostly senior secured, 40% loan to value loans or lending to investment grade companies. That is a great way to get safe yield for our clients. And so once you sit down and you talk to them about the facts that we see on the ground and that we don't see anything near what the noise is about some looming crack or issues in the market, they understand, and that's why they continue to deploy with us.
Maybe there is some confirmation bias that when these things pop up, people read a lot into them. The most recent one this week, decidedly not Blackstone, BlackRock and their HBS business, another fraud uncovered. Is there any incremental new information in that when that fraud pops up? Is there anything besides just idiosyncratic problems in individual companies?
Yeah, look, we're learning about that situation as well. I just read about it too. A couple of things. One, it's hard to draw a through line of fraud into broader credit issues. Those tend to be quite idiosyncratic, and we still believe that. But another thing that we always talk about is where you invest and who you invest with matters. And so on where you invest, these issues that have come up have been around the asset-backed finance marketplace. But asset-backed finance is a broad marketplace with dozens of different verticals. And what we tend to focus on is hard assets, infrastructure assets, data centers, energy and power projects, residential mortgages. Those are much more resilient, much easier to diligence. We have zero exposure to inventory and receivables finance. So that's one piece of it. And then who you partner with also matters. 98% of our direct lending portfolio is with private equity sponsors and public companies. All of the situations that have been in the press, non-institutional ownership. And so that's another thing to focus on as well.
I want to ask about when you travel around and when you do these deals, you gather really valuable intel that investors want to hear. So what are CEOs telling you about it? It seems they're very confident about the economy going forward, considering the amount of deals they're making. And do you think we're going to continue to see a lot more M&A, especially around something like Sabre, providing energy for this AI build-out?
Look, we mentioned last week, we do see this deal dam breaking, right? When consumers are confident, when earnings are strong, when valuations are healthy, that's the environment we're in today, companies transact. And so you saw M&A volumes up over 60% last quarter. If I look at our pipeline within our credit business, it's up over 20%. And that's why you see increases in deal activity. You saw a big deal we announced this week with Signet Health in the healthcare and life sciences space. You see a deal like you referenced, Sabre Power in the energy and infrastructure space. But it's not just the fact that deal activity is picking up. It's also these thematic areas. And you made a great point around insights. I'm lucky to work at Blackstone. We have 5,000 credits that we monitor, tens of thousands of real estate assets, hundreds of private equity portfolio companies. That allows us to focus on the long-term thematic drivers where we see tremendous investment opportunity. Obviously, AI, energy, and power, top of the list.
And then you get to brag that you're the biggest data center owner. But for the rest that aren't there yet, is there kind of like a FOMO trade underway in the rest of private capital that wants to try to rival you in that data center ownership?
Well, I won't comment on that other than to say we just see great investment opportunities in that market. We have tremendous insights, like you said, through private equity ownership, but also what we're doing on the ground in credit, and you'll see us continue to deploy behind these themes.
I hope we can keep getting those insights from you, Z. Please come back and join us again. Blackstone's Michael Zawadski here. Now, still ahead, we're going to get more on the credit landscape. We have Blue Owl Capital's co-CEO Marc Lipschultz joining us next. This is Bloomberg Open Interest. Let's get a check on the stock market right now. We are looking at, gains that are dropping. We're only up now about 0.4%. As Danny mentioned earlier, one of the problems is that Apple had turned around and has lost some ground. We still see huge gains in Amazon, right? Up 11%. Nvidia right now up 1.2%. And for a $5 trillion company, that's helpful. Tesla, Palantir, Netflix, some of the smaller of the Mag 7. Microsoft is a loser today, down 1.7%. And that's not helpful. In fact, two of these big companies, Meta also down 1.33%, and Apple, Microsoft and Apple, both $4 trillion companies. So when they fall, they tend to weigh on the market. In terms of what we've seen, I wanted to look at a broader picture, partially because Joe recommended it, but also because we've been getting these ups and downs on the day, and to smooth that out, here's a 5-day look. So IT, the big winner this week, consumer discretion up 3.2%, and the hyperscalers up 0.5%, but everything else has really been a loser. So it's interesting to see continued gains, as Danny mentioned, third week in a row of gains, 6th month in a row of gains, and yet we have more losing groups than winners. Danny?
Have you always said consumer discretion? I've just only noticed it this week.
Yeah,
this a new thing?
It's just a more fun way to pronounce discretionary.
Yeah. It's beautiful and it's wonderful. Thank you for that. Okay, coming up on the show, Blue Owl reporting a 21% jump in AUM growth. We're going to speak to Marc Lipschultz, Blue Owl Capital co-CEO, coming up next. Blue Owl reported results this week after joining forces with Meta on AI data centers. The firm reported a 21% year-over-year jump in AUM as it continues to reinforce its long-term growth pipeline. Joining us for more is Marc Lipschultz, Blue Owl Capital co-CEO. Marc, wonderful to have you on this morning. And I know whenever anyone asks about the equity price, you very astutely are like, we don't concentrate on the short term. But there was a decline after earnings, so we have to address it. You had record fundraising, maybe a concentration on some of the flat fees. Why the disconnect between the two?
Yeah, look, we had a great quarter. We had continued extraordinary growth, 20+% growth on the top line. I think there is, as you just noted, this disconnect, which is having acquired very successfully and very fortunately businesses like our digital infrastructure business IPI. You issue shares, but then you don't have a full year of their results. So it's actually just math. As you look at our run rate growth per share, it is continuing to accelerate, and it continues to be incredibly robust. So, there's a little bit of math, but it really is just simple math. Business is really thriving.
I learned so much from watching Danny's interviews with people like you. So she had...
to be clear, you're learning more from Marc than you are from me.
Yes,
I'm just happy to be there.
And from, Z, and from Henry McVeigh, and from John Gray. You were talking with him, Danny, and he was saying something about easing excess returns in private capital. And there's a market saturation. We see very tight spreads, and generally lower yields are headed lower. What do you think about that? What do you think about that idea?
So I would decompose the question of kind of yields, returns into three components, right? One, of course, is credit quality first and foremost. Like at the end of the day, the most important thing is that you're making good loans and getting paid back.
No cockroaches.
And so we want a very healthy ecosystem, and we have a very healthy ecosystem. We really do, and we can certainly come back to that. So credit quality is excellent in our book, and that doesn't mean no defaults. Everyone's going to have defaults now and then. We said multi-trillion-dollar industry. That's okay. You just can't have many, and you have to get good recoveries, and that's exactly what we do at Blue Owl. And by the way, so do our peers, and so do the banks. So the system is in a strong place. Then, of course, there's base rates, and of course, the direction of base rate travel. Everyone obviously sees it having eased from the peak, but again, every time consensus spills to, it's obvious, you look at the Fed commentary, now it's not quite so obvious how fast rates are going to go down. And then last is spread. And spreads are on the kind of, I'd say, the lower side of where we operate, but over a 10-year window, they ebb and they flow. And remember, we're building portfolios that have hundreds of names in them. Some are from a couple of years ago, some are current. And most importantly, our overall spread, the premium that we offer to the alternative, the traditional marketplace, has actually been stunningly steady at close to a couple hundred basis points. So, we don't live in a vacuum, and so spreads in the whole world are tight. Of course, ours are tighter. Equity markets are at all-time highs. Like we don't live in isolation, and in that world, spreads are a little bit tighter, but in total, we continue to deliver really outstanding investor results, and that's why we had record fundraising results.
I have to say, I really like that point you made about, okay, if we're concerned about private credit, shouldn't we be concerned about equity markets too? They both are trading and reflect a large part of this economy. I would then love to get your take on Meta yesterday. I know you're not a public stock guy, but when they issued more debt, Meta shares fell. Do you think that there are starting to creep into the market some concern with Meta, of course, is one of your partner, but the large hyperscale spending and the amount of financing and debt that they're taking on? Is there any reason to be concerned? Because clearly the equity market is starting to show at least a little bit of nerves about it.
Well, there's been several earnings reports this week from tech companies, and actually some of them performed extraordinarily well, announcing big capital programs, right? Amazon. And so I think it's hard to attribute it to one specific action. In fact, the collective result is, of course, tech is touching all-time highs at the moment where, as of this week, people announced, you know what, we're actually going to spend a lot more on AI infrastructure than we thought, much more actually, right? This continuing curve, every time you look, it just keeps going up, and you listen to the commentary, and the commentary is, we don't think we're spending enough. Microsoft says we don't have actually enough capacity to even fuel both AI and kind of our core business. So that gap, well, very expensive to cross that Rubicon, of course, is what creates the opportunity for great partnerships, for us to bring that kind of capital in conjunction with these spectacular companies to build the backbone, which for us is the very safe way to participate, build the backbone for this infrastructure, for the infrastructure for this AI future.
I was talking with Z about the intel he gathers, and you obviously are in the same sort of privileged position, right? You're talking to so many portfolio companies and CEOs, and you have an incredible view of, for example, the labor market. So what are you seeing in your portfolio companies, or what are you hearing people say about the economy in regards to the labor market? Are they going to be slowing hiring or even reducing jobs as they replace some of that productivity with AI?
So portfolio companies are, let's start with, very strong and healthy. We have 400 or so in our portfolio. And on average, growth remains, both revenue and earnings, in the high single digits. So it's a very healthy place. No, we're not
strong companies can reduce headcount as well. Right?
Absolutely.
Yeah.
So no, we have not seen any meaningful change in labor practices, but it is certainly the case that technology itself is making a lot of activity already more productive, and we're at the very front edge. So, you know, it is certainly the case that when you build and invest this kind of capital, you do ultimately have to get a return on it, and some of that will disrupt the traditional labor market. But we are not hearing anything I would call systemic or dramatic at this point within the portfolio. And to the degree it's happening, it's really more about efficiency, technology. It's not about concern about the economy today.
Blue Owl has also been on the forefront in moving into retail and offering wealth products to a wider swath of investors than traditionally had been. I just wonder, Marc, because this has been a period where it feels like people are laser focused with the magnifying glass, if I can mix all my metaphors, on private credit, with Jamie Dimon saying cockroach here, concern about fraud there. Has it changed at all retail sentiment? Has it been harder to reach those people just in the volatility of headlines that have been coming out?
So here's the really encouraging part about the wisdom of what you call retail investors, individuals taken together. You know, I think there's a propensity to want to either sort of, people say, oh, they don't understand. I actually think there's incredible wisdom in the individual investor world. And by the way, they're advised by really strong people, right? The financial advisors at the Merrills and the Morgan Stanleys and the JP Morgans, the Goldman Sachs, I mean, all these, you know, Wells Fargo, all these fabulous places are advising people on making these choices. So here's what we're seeing. Wealth flows are accelerating even now, this month over last. We see this every day. It's a very data-driven business for us. We are accelerating in wealth this month over last. So actually, I think people are seeing through this noise, and it is a lot of noise. And to your point about, you know, sort of an item here, an item there, you know, I would suggest when we take a step back, because there's almost this kind of this mass hysteria taking hold about credit in general, private credit in particular, and it's just not anchored in any facts. It's anchored by repeating a few anecdotes and then kind of just creating the, well, hey, you never know. And some of that is, you know, intentional. Some of it, I'm sure, is quite sincere by people that just don't They just aren't sure. But the truth is that our system, the private credit system, not just Blue Owl, our peers are very good at what they do. The banks are very good at what they do. And in total, fortunately for the economy, we have a very healthy credit ecosystem. And to the earlier point, Danny, you repeated, which I think is really important to remember. You cannot believe that we have an unhealthy credit ecosystem and a healthy stock market. Those are not compatible ideas.
Well, and I mean, as you point out, the concerns are belied by the fact that investors are still falling all over themselves to get access to funds like yours. Marc, great having you on the program. Thank you so much for joining us. Marc Lipschultz there of Blue Owl Capital. Let's take a look at these equity markets. They continue to move higher, not the gains that we saw at the top of the hour, but still more than 0.5% to 68.60 on the S&P 500. So near the all-time high, a closing high of 68.90 still. The NASDAQ over 26,000 right now, and the 10-year yield coming down a little bit over 4%. A look at the earnings beyond AI, because clearly we have a lot of focus there, but there's other stuff going on. And yesterday, you know, I listen to Bloomberg Business Week all the time on Bloomberg Radio, one of my favorite programs with Tim and Carol. And yesterday I heard an analyst talking about Chipotle and Shake Shack and Starbucks, and I thought, this guy is brilliant. And then I realized it wasn't an analyst, it was Red Brown, Bloomberg reporter here with some really, I think, insightful looks at these companies that are doing some better, some worse. Chipotle had a horrible day, doesn't seem to be doing well at all, no matter what they try. And yet you have other companies like Shake Shack that is doing well. So is it an idiosyncratic problem that Chipotle has, or how does the restaurant scene look to you?
It's interesting. You put a lot of pressure on me there with the lead-in, but see if I can repeat my performance. I do think that right now the evidence that we have, so thus far in this earnings season, we still have some more of these like similar type fast casual restaurants with Cava and Wingstop reporting later next week. Right now, though, it does appear like there's something going on with Chipotle. It's not just this quarter, it's also this whole year, right? Chipotle has now cut their earnings guidance their sales guidance 3 times this year. So, you know, I don't think that we can point to another company within the restaurant space that has done something similar. So there clearly does seem to be some pressures particular to Chipotle and how they're managing this sort of consumer slowdown.
By the way, was once one of those stocks that you could always count on to deliver solid earnings returns, right?
That was literally going to be my question, because there was a moment where Chipotle, and it was the Chipotle bros who on their lunch break loved to go and get a burrito bowl and get an extra scoop of whatever. So good that...
Carnitas.
Yes, carnitas. So good that Starbucks hired from Chipotle to shake up their C-suite. How have their fortunes changed so much? What went wrong?
Yeah, it's interesting. Yeah, the Brian Niccol era really was like peak Chipotle. I think since then, they're dealing with a lot of these like value perception issues. So I think also this sort of got memed, like Chipotle got memed for like issues with their digital offerings. So sometimes people would I've heard anecdotes of people having to go to the Chipotle now. They don't trust the digital. They don't think they're getting enough food as they usually do. It's seen as a little bit of a premium offering, even though it is a lot of food. I mean, anyone who's had Chipotle recently can attest to that. So
their burritos are like small babies, yes.
Yeah, exactly, right? It's like it'll knock you out for a little while. But so they are dealing with that a little bit. That did come up on the earnings call as well. They're dealing with this like kind of value perception still. So they're having a little difficulty like navigating this this moment of saying like we are really good value, but it doesn't seem to be resonating with people.
Why can't Brian Niccol deliver the same kind of magic at Starbucks as he did at Chipotle? I mean, you look at the stock over the last year, Starbucks stock, it's down 16%, and he has made some changes, but he doesn't seem to be doing it very quickly. I heard you mention how many stores he has revitalized. Out of the 18,000 that they run, only 70 so far, and he's been there for over a year.
Yeah, I mean, it's like turning a tanker, right? Like Starbucks is massive. 18,000 is giant. It's been a year.
Yeah, but 70 is nothing.
70 is less than 1% of that footprint. So, you know, this has been a big part of his turnaround plan, is like revitalizing the brand through the actual tangible environment with which we all feel Starbucks. So we will see they are committed to doing 1,000 stores within the next year. So we will get to see whether or not that really does start to bear fruit. We did some reporting this week about how people are interacting with Starbucks, actually not spending a whole lot more time in the stores despite some of these changes. That is another thing that they've touted as wanting to do. They want people to spend time there rather than just make your coffee or just grab your coffee and run. So yeah, it remains to be seen. We should get outlook in January from Starbucks, and that'll be the first, I think, real real tangible data point from that company to say, like, yes, we feel confident in this turnaround now, enough to give you an outlook, right?
He did say so Brian Niccol was on The Close with Romaine a couple days ago and pointed out they're the biggest, or was it yesterday? Was it yesterday?
It was yesterday.
The biggest, obviously, coffee seller, but also the biggest cafe chain operator, the biggest coffee delivery company. I mean, they're the biggest of everything that has to do with coffee, so.
I guess the protein foam isn't enough, basically.
So
delicious,
powdery.
delicious protein foam. Hey, Red, this lived up exactly to the hype which it deserved. Red Brown, thank you so much for joining us. Coming up on the show, the demand for H-1B visas is surging. Wall Street Week explores the new 100,000 price tag and what it means for companies and Wall Street. And another must-watch story, our original investigation, Can't Look Away, the case against social media, is now available on Bloomberg platforms. It exposes the real-world consequences of harmful algorithms.
These companies have been gaslighting us for years.
This is all about money.
The purpose of all commercial ventures is to create a demand.
Our children are the casualties.
We need to take back the power from these companies.
They created a dangerous situation and then manipulated these kids.
They know the levels of addiction, sexual abuse. They know the levels of suicide. They're not showing our kids what they want to see. They're showing you what they can't look away from.
Time now for a Wall Street Week conversation. U.S. employers looking to hire talented foreign workers now have to pay $100,000 to sponsor their H-1B visas. David Weston looks into who benefits, cui bono, and who's left behind.
They've been around since the Immigration Act of 1990. And actually, there's been almost no change to them since then.
Britta Glennon is an assistant professor at Penn's Wharton School of Business who has studied the effects of the H-1B visa program on business and the economy.
They're a skilled immigrant visa, so they're primarily used for those who have at least a bachelor's degree, if not, master's or PhD. They're really the primary skilled employment visa for immigrants. They are tied to a firm, right? So something that's sort of important to recognize is that you actually cannot get an H-1B visa without an employer sponsoring you. And the employer actually, they're the ones who submit the application, not the individual.
The U.S. limits H-1B visas to 65,000 each year, with 20,000 additional visas for those getting graduate degrees from U.S. institutions. But several times that number apply, which has led the U.S. to create a lottery to pick visa winners, and to criticism about the overall approach.
It's pretty clear that we need more than 85,000, and just the fact that demand is so much higher than supply every single year, I think exemplifies that. I mean, when it was first formed, demand was below the cap. They ended up raising the cap in the late 90s because demand started growing as you had kind of the internet boom, right? And Silicon Valley became much more significant. And then that expired in 2004, and basically since then, supply and demand have been on completely different trajectories.
The big mismatch between supply and demand has created large business opportunities for companies not looking for skilled employees themselves, but to getting visas for workers they can provide to the companies needing them. In 2023, nearly half of the H-1Bs went to outsourcing or staffing companies. Todd Schulte is the president of FWD.US, a company that focuses on reforming the U.S. immigration and criminal justice systems.
So there's been, over the years, efforts by companies, and I would say a lot of bad actors, to basically kind of game any particular system here. Really, it's a function of Congress has failed to update our immigration system in a lot of ways here.
And you can catch Wall Street Week tonight and every Friday night at 6 p.m. New York time. Coming up, we hit day 31 of the government shutdown as SNAP benefits come into focus. We head to Washington, D.C. next. You're watching Bloomberg Open Interest. Let's Let's get you set up for your trading week next week. Tomorrow, we're going to get Berkshire Hathaway earnings. Plus, SNAP benefits come to a halt as the U.S. government shutdown continues. Monday brings PMI and ISM manufacturing data. And Tuesday, it's election day in the U.S. with pivotal state and local contests on the ballot, including New York City's mayoral election. Wednesday, ADP employment data rolling out, which is especially important because the shutdown, Matt, means we are not getting official government data.
All right, well, speaking of the shutdown, let's bring in Bloomberg News, a congressional reporter, Alicia Diaz. Alicia, we are now at the end of October, so 31 days, I guess, is how long the shutdown has lasted. Is there any sign that, the Democrats are willing to get with this clean CR, or are they still demanding negotiations before they're willing to help the Republicans reopen this government?
As of right now, things are still the same as they were for the past couple of weeks. Democrats are still holding strong on demanding that Obamacare subsidies are extended and included in any legislation to fund the government. Republicans are still standing on their talking point, which is that, pass the government funding bill first, and then we'll have negotiations. And so senators have left town for the weekend. The House has not been in session for the past 4 weeks or so. Things are not looking optimistic for a deal the next couple days. And as you said, the stakes could not be higher. Millions of Americans will be facing food shortages if they're relying on food stamps. And that's really going to start to hurt the average consumer as well.
I hate to be cynical, Alicia, but what's going to matter more, that or the fact that airlines are struggling without air traffic control getting pay? At Orlando International Airport yesterday, there were delays that averaged 2 hours and 40 minutes time. And you start to see airlines, American among them, saying, hey, Congress, you need to pass a clean CR. Is that enough to influence Congress to act at this moment?
It remains to be seen. I was on Capitol Hill yesterday, and some senators who were trying to leave town said that their flights were delayed and they couldn't get back to their districts for the weekend. Of course, we know in the last long-held government shutdown, which was in 2018, 2019, those airline shortages were really what drove lawmakers to make a deal. So it is very possible, especially ahead of the Thanksgiving travel season, that this ends up being a pushing point for them. And at the same time, we have a lot of other consequences that are starting to build up as well.
All right, Alicia, thanks so much for joining us. Bloomberg's Alicia Diaz reports on Congress for us, and we'll bring you any details as they emerge. Or listen to Balance of Power every weekday at noon on Bloomberg Radio and starting at 1 o'clock on Bloomberg Television. Coming up on Monday, Stuart Kaiser of Citi joins us, as well as Sitara Sundar of JP Morgan, plus PIMCO President Christian Straka and Link Logistics CEO Luke Petherbridge. And I hope you have a fantastic Halloween.
Yes, who's going to dress as a cockroach and an exterminator?
Not me.
Someone on surveillance said that they dress as an economist without data.
My daughter is going as Elsa, and I think I will dress as Anna.
Please
from
take
Frozen.
pictures. Sounds adorable.
This is Bloomberg Open Interest.